So today we're going to talk about a topic I know all of you hate. That's right. We're going to talk about fees, and fees. Specifically, we're going to talk about the fees as it relates to life insurance. And we're going to look at what is the most expensive life insurance that you can buy. Well, if you listen to Dave Ramsey or Susie Orman or any of those gurus, they're all going to tell you the same thing. Whole life. Whole life's the most expensive life insurance there is. That's what they're going to tell you. Well, today, I'm going to literally take you through the entire gamut of all the different products, the different life insurances out there and the fees that are associated with them so that you can get a behind the curtains look at which one is the most expensive life insurance. And I got a spoiler alert, it's not the one you think. Let's get in. So the way I thought I would do this is literally just walk through all the costs on each product, on each type of life insurance you can buy. Let's start with the most common, the most widely sold, widely talked about, and Dave Ramsey's favorite life insurance, term insurance. So first off, do you understand what term is? Well, let me give you just a 30-second. Term insurance is a life insurance that you would buy for a term of time. So if you think you're going to die in the next 5 years, then you buy a 5-year term or a 10-year term or a 20-year term or a 30-year term. You're buying a term of time of protection on your life. In other words, you're kind of renting your insurance. That's it. You know, how long do you want the lease to be? Well, I think I'm going to stay on Earth before I go to heaven for, 20 years. So you got any 20-year leases on those life insurance policies? Yes, we do, sir. We have a 20-year term perfect for you. And it's really inexpensive because that's what they're always going to say. Buy term. Why? Because it's the lowest cost. And rightfully so, it would appear that it's the lowest cost because it has the lowest premium in most cases. So here's what you got to understand. Term insurance. Why is it the most talked about? Why is it the most sold? Why is it that more agents sell term insurance than any other life insurance there is? Because it's easy. That's why. Because it's perceived to be the cheapest, therefore it's the easiest to sell. But how many of you go out when you're looking for a product? You're looking for, I don't care, a new car, you're looking for a house, you're looking for a nice suit to go out. How many of you literally go out and buy the cheapest car you could find, the cheapest house you could find, the cheapest suit you could find, anything that you buy? How many of you literally go out and only buy the cheapest of whatever it is you're looking to buy? Probably none of you. And if someone said, oh, I do, I always go out for the cheapest of everything. I don't even know why you're here, but probably nothing I do would fit the bill for you because cost is only an issue in the absence of value. Let me say that again. Cost is only an issue in the absence of value. So we really need to put more emphasis and more focus on the value that we get. So term insurance, what is the value? Well, there is some value. I own term insurance. I have $1 million term policy on my life. Why? Well, because I took that $1 million term policy out to protect 30-year mortgages on rental properties that me and my wife bought. So it fits the bill, the value's there. I want a cheap life insurance plan to protect me for a term of time to protect a specific risk, mortgages. 30-year mortgages, which I'm paying down, and every year I'm paying them down more. So I'm actually overinsured right now for the amount of mortgages that I have. So if I pay the mortgages down, then the insurance is more. But the insurance makes sure that if I die too soon, within that 30 years, the life insurance benefit would be paid out to our entity, and that entity would pay off those mortgages. Done. So you see, there was a specific value I was after, and that value had a term of time associated with it, and that was a 30-year mortgage. Maybe you want to protect your car loan, and that's a 5-year car loan, so that would be a 5-year term. Maybe you've got a risk that is 10 years, and after that, there's no more risk. A 10-year policy would be appropriate. And we're going to come back to this in a little bit, but what is the true cost of term insurance? Let's pause there. Real quick, let's move on to the next life insurance. So let's pause on term insurance. We'll come back to the real cost of term, but let's go on to the real cost of universal life insurance policies. These are permanent policies, which were created back in the 1980s, and they were created to take advantage of higher interest rates back then. So if you look back to the 80s, interest rates were relatively high, kind of how they are today. And they wanted to take risk off of the insurance company and put it back on the client, which the traditional life insurance, whole life, did the opposite. It put the risk on the insurance company, not on the client. So how they did this is they created a product called a universal life. Now, this product was very attractive to agents to sell. It was attractive because it provided flexibility a whole life policy did not. That flexibility was in premium. So you could start a policy at $500 a month and you could reduce it down to $300 a month and go back to $500. But the inner workings of these policies, the traditional universal life, which will go 2 layers deeper into universal life, was how. Now, the cost of insurance in a term policy, depending on the type of term, essentially goes up every year you get older. It would be annual renewable term insurance. So every year you get older, your cost to insure $1,000 of insurance on your life goes higher, right? So every year, each unit of insurance goes up because you got less time to live. I mean, we're all on a clock here. We're all in a limited amount of time here on Earth. So they know that. They have actuaries that know these calculations. So therefore, every year inside of a universal life, the cost of insurance goes up. But it starts, if you're young, it starts very low. And then over time gets more and more and more expensive. Now in the early versions, that was all mitigated by interest rates. And interest rates were as high as I remember in the 5% range back in the 2000 range. They were in 5%. So they were even higher back in the 80s. So they would have an interest rate, but that interest rate was not guaranteed to never change. So how it worked is if you had an interest rate on the guaranteed side, because you always had a floor, let's just say that was 3%, okay, but you were currently making 6%. So 3 is your guarantee, 6 is your current rate. So all your calculations were based on 6%. So as you got older, if that interest rate went down on the non-guaranteed and met your guaranteed rate, which all of them did, so 3%, now all of a sudden your illustration, your hypothetical was based on that higher non-guaranteed interest rate, and now it's lower, but your costs continue to go up. These policies had major issues with lapsing because the cost of insurance exceeded the interest earned. So the only thing that could happen is the client had to put more money in premiums in just to keep the policy alive. It would be like trying to keep a term policy alive when you're 70 or 80 years old. Good freaking luck, because every year that cost of insurance is so expensive, and rightfully so. The actuaries don't want to pay out death benefits, so they know that the more cost there is, for the older you get, the less of a chance you're going to keep the policy. So if you basically make the cost higher and higher, there's a strong probability that people are going to lapse their policies and the insurance company wins because all the premiums paid to the insurance company are kept by the insurance company, but you no longer have the coverage. I mean, listen, insurance, there's a good side and there's a bad side. That's the bad side. I mean, do car insurance carriers want you to crash your car? No, they want you to go on and never crash your car. They want to keep raising your premium. Same thing with homeowners, right? If you're in a area where there's flooding, they don't want to insure your house anymore. If you're in an area where the house, could burn because of forest fires, they don't want to insure it. So insurance companies are always mitigating the risk to them. Universal Life was a perfect product for the insurance companies to mitigate risk for them. It put so much of the risk on the insurance company, on an interest rate that the insurance company could change. That was then, but let's move forward to now. Today, Universal Life has taken on many shapes and sizes, from no lapse guarantee riders, which cost money, to VULs. Now, let me explain a VUL, Variable Universal Life. Now, you've heard Dave Ramsey say, buy term, invest the difference. Well, the insurance companies heard it too. And they said, well, we can do that with one product. No longer do you need to buy insurance, term, okay? No longer do you need to buy term and go out and invest the difference. The insurance company said, we'll wrap it all into one product and we will call it a Variable Universal Life. So you get a death benefit, which the cost of insurance goes up every year, just like term insurance. So it's really inexpensive cost of insurance in the early years. The older you get, it gets more expensive, but that's okay because then we'll let you invest the difference in a basket of mutual funds that are all part of the same thing. So now you can buy mutual funds in a tax risk-free environment, which is called life insurance. And we sold the crap out of these back in the early 2000s, all the way up to the Great Recession. We sold tons of variable universal lives. And if you have an agent that was around back then, they sold tons of them too, because it seemed to make sense. The markets were doing really well, so the basket of investments, the mutual funds, kept the policy making a bunch of money, and the cost of insurance was really low until 2008 hit. And in 2008, the Great Recession, the mutual funds lost significant money. So now, not only were you not making the returns on the investments, your cash value was hemorrhaging losses while your cost of insurance was going up and up and up. And then there was the premium, which was always a target premium. So the target was based on a hypothetical return or a hypothetical interest rate. So now, this hypothetical target premium, which in the beginning seemed perfect. Oh my God, I'm only gonna pay $200 a month. I'm gonna have millions of dollars in cash value, and I'm gonna have life insurance the rest of my life. Now all of a sudden goes, done. Okay, but it's kind of like this. You know, that variable universal life looked great on paper. The hypothetical scenarios, which the agent or the advisor, and actually VULs could only be sold by Series 6 and 63 or financial advisors with a Series 7 license. So you had to be an investment licensed agent or broker, okay? So it was a financial services professional is what they call them. Normal agents couldn't sell VUL, but I owned one. I had one in my life. I now have since replaced it with a whole life, but my policy blew up in 2008. And it would have lapsed if the company I had my policy with didn't do a freeze on all lapsing, because they knew that those mutual funds eventually would come back and the policy would be fine. But my policy's cash value never really came back. It was never a good investment. And just like most people that do buy term invest the difference, it usually doesn't work. Well, the VULs usually don't work. How do you like those apples? Well, let's pause on the apples real quick, because I'm giving you some really good stuff. If you're taking notes, great. Take this one down. Click that button. It says subscribe, click it. That's right, write it down. And while you're at it, smash that bell right on the top. So while you smash that, that's great. It's gonna notify you of all the new videos that I put up, so you can always stay in the loop. But what we're gonna do, with the Super Bowl coming up, we're gonna play a little one straight off of Taylor Swift. I'm not a fan, but maybe you are. Taylor Swift's dating one of those Chiefs guys, I don't know, what's his name, Kelsey or something like that. He goes long a lot, so we're gonna really give this a whirl. Okay, I'm gonna step back in the pocket. Go, go! Yep, that one was blocked. You see that? Pretty good block, man. I put that shit high and it was knocked down. Anyway, maybe that happens in the Super Bowl, maybe it doesn't, but that just happened for real. Anyway, getting back into it. You don't want to be blocked by the insurance company. And the block by the insurance company is you buy a product based on a hypothetical basis that doesn't work out. You know what the biggest one is right now? I talk about this all the time. The biggest one that absolutely will be blocked, I don't know if it'll be blocked by regulators, it'll be blocked by false promises, it'll be blocked by all these agents selling them, will probably be served arbitration or lawsuits against them. Yeah, it's an interesting product. You've probably heard about it. It's called an IUL, Indexed Universal Life. Now I gotta be careful what I'm saying, because I really hate these products and I tend to really explain that. It's kind of like what I mentioned with the VULs. It's like buy term, invest the difference, but remember with the VUL, you could lose money on the basket of investments you invested in. So the insurance companies have kind of crafted this new thing out of Play-Doh and, I don't know, sharp shards of glass and sharp things. So if you're playing with the Play-Doh, eventually your hands are all cut, but you just were having so much fun playing with it, you didn't even know you were being cut. Anyway. Hope that we pick up what I put down there. So these products allow you to participate in a basket of indexed investment. So this concoction that the insurance companies did 100% puts all the risk on you, okay? Because what they're doing is they're basically saying, hey, buy term, remember that annual increasing cost of insurance by term. Invest the difference with us. Just give us your money. We will allow you to participate in our returns on this basket of indexes that we put together, that they basically just get a room full of a bunch of Harvard kids that know nothing really about investing, but just find the best returns and all these derivatives. And then they buy derivatives, which are options on these indexes. I'm probably going too deep, but anyway, the whole purpose is they'll allow you to participate up to a certain rate of return or an uncapped rate of return, and there's no downside, because you can't lose any money. Remember the VUL, you could lose money, and that's what happened to mine in 2008. I lost a bunch of money in the investments, but in an IUL, you can't lose money because it's got a floor. How cool, right? You can participate into the returns of the indexes up to a certain point or uncapped, but there's always a floor. You can't go down. You can't lose money on those investments. Not too bad, right? So what happens? How could that be bad then, Chris? How could that not be good? Like, I can't lose, but I got, ability to participate into this return that the insurance company basically allows me so graciously to participate in. How could I lose in it? Let me tell you how. And this is what's happening. And to date, and I've been doing this a lot, I have not seen not one IUL illustration that beat its illustrated returns. And let me point out that we've been in the longest cyclical bull run we've ever had, which means the stock market's been doing really well, which means an IUL should be outperforming the illustrations, because your participation rate's got to be better than what the agent put together on the paper, right? Well, clearly wrong. So in these IULs, the one biggest fault I have with them is the agent selling them, number one, don't even need to be investment licensed, but they're technically selling an investment. I've heard these guys sell these on social media. They're selling the investment, but they're not investment licensed. They don't have a 663, they don't have a Series 7, no 65 license. These are all investment licenses. None of those. They're just agents that got their life license that are going out and selling an IUL because that's what they're told to do, and because it pays the highest commission. That's right. IULs have one of the highest commission structures there is, which is why all the brokers love selling them, why all the agents want to sell them, and why you hear about them all the time, because the insurance companies are marketing them heavily because it takes the risk off the insurance company and puts it on you. Therefore, they pay a bunch of money to the agent. Now, all those universal life products, the UL, the traditional UL with the guaranteed interest rate, and then the non-guaranteed interest rate, to the VUL with the separate account of mutual funds that you can participate in all in one, buy term, invest the difference, to now the IULs where you can participate in the returns of the index but with a floor. So it's just the greatest thing. All of these products have what's called a surrender charge, which means the money you put in, they're gonna throttle you back, cash value. There's gonna be a surrender value and your actual cash value. Pay attention. Surrender value, actual cash value. Your actual cash value is gonna be whatever it actually is earning. Your surrender value is going to be the actual cash value minus a percentage, and they're all different, for a particular period of time, so that the commission, the big absorbent commission paid to the agent, broker, whoever sold you the IUL, that commission is recaptured by the insurance company. Brilliant idea, right? Let's not allow a client to cancel their policy, surrender their policy, or just give their policy up until we've gotten our money back that we paid in commissions. And since the commissions are really high, it might take 5, 7, 10 years to get those commissions back. So we'll put a surrender charge on there. So if one of these clients decides that they're going to try to beat us and they want to surrender their policy in year 4, we're not going to let them take all their money. Matter of fact, if they never surrender the policy, we're not going to let them even use that money while it's in the surrender period. So therefore, these products do not work well or at all for the infinite banking concepts, which is all I teach. Now, let's conclude to the final life insurance product that we're going to talk about, the one I always talk about, whole life insurance. But I'm only talking about whole life insurance from a mutually owned insurance company that pays dividends. So these are some of the top mutually owned insurance companies that we deal with. Now, whole life. how does whole life differ from all the other ones? Well, Dave Ramsey says it's the most expensive life insurance. Why does he say that? Well, probably because the cost of insurance for each unit of insurance is fixed. It starts higher than an IUL would. It starts higher than a VUL would. It starts higher than term, and it starts higher than that normal universal life. Why? Because it's fixed for the rest of your life. It never goes up, and it never goes down. It is level for the rest of your life. So no matter how long you live, your cost of insurance will be based on your age today. So if you're 55 today, your cost of insurance is level at 55. So when you're 70, guess how much you're paying in cost of insurance? The same amount you did when you were 55. Yeah, those are some really good stats. Now, if in an IUL or UL or VUL, all those, your cost of insurance started really low. So whole life was here, cost of insurance on the UL was down here. But over time, that cost of insurance ramped up in the UL to be far more when you're later in life, when you're more likely to die. Your cost of insurance is higher, so that there's a strong probability that you're not going to want to pay more in premiums when you're older because you're now retired on a fixed income, yada, yada, yada. You're probably going to lapse the policy. But whole life, cost of insurance is completely level. Okay, that's the first thing. And that is one of the most important things. It is for your whole life. It never ends. Term insurance is not for your whole life. It ends, okay? Secondarily, whole life insurance has a contractually guaranteed interest rate. Never changes for the rest of your life, okay? Kind of like that original UL that had that guaranteed interest rate, that never changed either. Same thing. But then whole life pays a dividend. And the companies we have used have paid consecutive dividends every year that these companies have been around for over 140 years, never missing one, and they've always paid a dividend, okay? So that dividend plus the interest gives you your interest rate and dividend. So they call that the dividend crediting rate. So now you've got a product that has a fixed cost of insurance, okay? A product that now has a pretty stable return you're going to get on that. So over a long period of time, it's very difficult for any of these other products to even compete with a whole life. But in the short run, those other products can compete with a whole life, and in some cases will beat the whole life. Now let's up the ante. Let's throw in a little design and engineering, okay? You guys have all heard about designing and engineering, and if you haven't, well, just look at a car, right? Take a Ford Focus, I talk about it all the time. Take a race car driver, the late Ken Block, and then put Ken Block in a normal Ford Focus off the showroom floor. Is he gonna like that? No. It doesn't have the power, it doesn't have the little e-brake thing, the big turbos, the 800 horsepower, doesn't have any of that. Ken Block is gonna have a hard time competing in a rally race in a traditional Ford Focus. So what does Ford do? Well, they design and engineer a Ford Focus with 800 horsepower, better suspension, a roll cage chassis, cool graphics, and that little e-brake thingamajigger, right? So you can hit it, send the car sideways, hit the gas, engage the turbo and the 800 horsepower, and go comfortably sideways at 130 miles an hour in pure bliss. So cool to see. Design and engineering did that. So now he's got himself a race car, but it is a Ford Focus. So let's design and engineer a whole life insurance policy where what we're going to do is we're going to mitigate some of that cost in that whole life. We're gonna reduce the base, which is the base of the whole life. And we're gonna layer in some term insurance to support the IRS rules. So we're gonna put in a 7 or a 10-year term policy because Dave Ramsey said they're cheap, and they are. And we only need it for a specific period of time, specifically 7 years, because that's how long the IRS essentially says we need to support the MEC 7 pay, 7-year limits for death benefit. If you wanna understand MEC, please watch another video or just Google MEC 7 pay and you'll understand that. And then what we're gonna do is we're gonna shove a whole bunch of extra money into the general account of the insurance company through a rider called a paid up additions rider. Different companies call it different things. So we're gonna overfund the policy. We're gonna reduce the cost of the policy, which is almost always the death benefit. By reducing the cost of insurance or the death benefit, we also reduce the commission. So now the agents, like myself, are receiving 60 to 90% less in commissions. Yeah, that's why those IUL guys don't wanna sell these because they like their big hefty commissions. They don't wanna reduce their commission 60 to 90%. But if we build and design this policy, this whole life, to maximize your cash value, one has to give our commission we have to give up so that another gets, so you get. So now we've got ourselves a super sexy race car-ish looking whole life policy that works really well for the infinite banking concept. And we've reduced costs quite a bit. So now when we compare the universe of life insurance policies from term to those universal life policies to whole life and specially designed whole life, which one is the most expensive? What I'd like all of you to do is in the comments right now, tell me which one you think is the most expensive. I'll wait. Yep, put it right down there in the comments. Okay, I see a couple of ULs. A bunch of people saying whole life still. Traditional whole life is the most expensive. Okay, that's brainwashing because Dave Ramsey and Susie Orman, but that's okay. Now, let me ask you, which one's the cheapest? Look at this. Term. Everybody says term, right? So we didn't really know which one was the most expensive. We were kind of going back and forth between IULs, VULs, and whole life. But now when I ask which one's the cheapest, all of you, because this is what you've been taught, you have conformed to believe this, that term insurance is the cheapest life insurance you can buy. Wrong. You're all wrong. I'm sorry, you're wrong. Why? Oh, yeah, I probably should tell you why, right? It's quite simple. You see, by the stats, life insurance companies pay out less than 2% of all death benefit claims on term insurance. Not death benefit claims, but all the death benefits issued on term policies, less than 2% are paid out. Check it out, here's the stats right here. So if less than 2% of all term policies ever pay a death benefit, that means that essentially, let's just round up and say 98% never get paid out on. So all the premiums that came in on 98% of all term policies will never be paid out on, which would be the most profitable outcome ever for the life insurance company. So which life insurance is the cheapest? Not term. Term's the most expensive because you've only got a less than 2% chance that that insurance policy will ever pay out. And if it does pay out, you died too soon. So it's a lose-lose. So cost is only an issue in the absence of value. So if you're buying term insurance outside of the value you're buying it for, if you're just buying it ultimately for death benefit protection for your whole life, you just bought the most expensive life insurance ever created because there's less than a 2% chance that that policy will ever pay out because you won't die. And the actuaries know this. So when you're really looking at cost as your sole driving factor for life insurance, you're looking at it all wrong because cost is only an issue in the absence of value. Whole life will always pay out. I hope this helped, folks. Thanks for joining me for this episode. And if you like this one, check this video out right here. BYO Bank. It's time for you to learn how to be your own bank. We'll see you next time.